Hello everyone and welcome back to another video. Today we'll be talking about whether or not the pandemic has created the perfect time for you to invest in real estate. Before we get the video started, make sure you subscribe to the channel, click the like button, and let's get this video started. The COVID-19 pandemic has created a lot of uncertainty around the world, but for some people, it has also created opportunities. Investing in real estate might just be one of those opportunities. If you're someone who has some savings in the bank, or you were thinking about buying a house but it wasn't quite the right time, the economic turmoil that we find ourselves in at the moment might have just answered your prayers. Before we look into the current situation, let's try and get an understanding of what actually drives the prices of real estate. Number one is the economy. When the economy slows down, house prices will usually slow down as well. Economic slowdown usually leads to unemployment because the companies in the economy are not performing at the level that they need to in order for them to show the financial results expected. Unemployment inevitably leads to less money going into the economy. Therefore, luxury products or products that are not immediately needed take a hit first and take the biggest hit of all. As with all prices, it's all about supply and demand. When the economy slows down, governments would usually use tax credits or subsidies to temporarily boost the market, and this is starting to happen as we speak. So when the economy slows down, demand goes down and house prices come down. Governments then introduce tax breaks and tax relief, which then encourages people who have a bit of money to spend on real estate or housing to then start spending again, therefore increasing house prices again. The second thing that impacts house prices is interest rates. Interest rates are set by the central banks, and it's a mechanism that is used to manage the supply of money within an economy. So if the supply of the money within an economy is low, then that means that prices will drop. If the supply of money in an economy is too high, then prices will increase. Importantly, when interest rates fall, that means mortgage prices will also fall because the interest paid on the mortgage that someone will have is going to be lower, therefore making the monthly payments more and more affordable. During an economic crisis, it's harder to get money. So although interest rates are lower, it's a lot harder for you to convince the bank to give you the money in the first place. However, if you can't get a mortgage, this is probably the right time for you to get one because you can get in at a low interest rate and therefore have cheaper monthly payments going forward. Similarly, if you already have a mortgage, this might be a good opportunity for you to refinance that mortgage so that you can move from your current interest rate to a lower interest rate. Remember, the most important thing when it comes to a mortgage is the monthly payment. The lower you can get the monthly payment, the better off you are. So the current lower interest rates that we have at the moment are perfect for the housing market because it's exactly what's going to be needed in order for people to have the confidence to go out there and start purchasing houses again. The third thing that affects housing prices is the policy in the area that you live in. By policy, I mean the central bank and governmental intervention that has been put in place in your local area in order to safeguard the economy and the housing and real estate market. This is probably the most important factor because without good policy, you cannot implement the low interest rates or make the right changes to the economy in order for you to stimulate growth again. Measures have been put in place to protect those who have been most affected by the coronavirus. One of these measures is to stop banks from repossessing homes for anyone who cannot make their mortgage payments. Furthermore, the coronavirus job retention scheme means that employers can claim up to 80% of their employees' wages plus any employer national insurance and pension contributions. The measures put in place, albeit appearing to be quite small, make a significant difference when it comes to how the individual is going to spend their money. One problem we have in the UK, however, is affordability. Now, this is the amount of money that people earn in correlation to how much money that they can actually borrow from a bank for a mortgage. The typical bank will calculate the borrowing amount of an individual for a mortgage of up to 4 to 4.5 times their salary. House prices in the UK and England in particular have gone up so much in recent times that the average person cannot get a mortgage that can cover their entire house. It's estimated that people in England would have to spend up to 7.8 times their annual salary on a house. So the 7.8 against the 4 to 4.5% that the banks are willing to lend means that people have to come up with a very significant deposit in order for them to get a house. What does this mean for anyone who's looking to actually get a house or invest in real estate in 2020? If you're looking to invest in real estate in 2020 or get a house, there are lots of factors that actually are on your side. For example, low interest rates, potentially low demand depending on when you're looking to buy, which means you might have a better opportunity to negotiate your house prices, as well as governmental policies like tax breaks, which will make the cost of buying a house much cheaper. All of that put together means that if you get a house today, you'll be much better off than people who get a house after the economy has fixed itself. However, it's not all good news. Houses actually coming onto the market have slowed down significantly since the pandemic, and this has got something to do with the current economy, because if people don't have money, they're not going to sell their houses. So actually, the low supply of the houses into the market means that a bargain or the right house for you is a lot harder to get, which means those ones that do come on to the market in any time, meaning that those that do come onto the market are going to be there at a premium. Despite the low supply of houses into the market, I do believe that there is a time to buy in the pandemic and an economic downturn. The time might not be now. However, there is a sweet spot from when the economy drops and right before it picks up again. As we've discussed, the housing market is greatly determined by the economy. And at the moment, we're not in a position where we know what's actually going to happen to the economy in the next 6 to 12 months. With coronavirus still a threat and more areas going into lockdown, albeit localized lockdown, this means that there's still potential for the economy to keep going lower and lower for a longer period. A longer financial downturn will mean that the governments can no longer support the policies that are there to prop up the economy in the short term, such policies as the ones that we've seen in this video. Furthermore, a lot of companies are still struggling with their revenue, and some of this will not be clear until we get closer to the end of the year. This means that unemployment and actually more financial hardship is likely to happen in the near future. If you happen to be someone that has not been impacted by the financial crisis, you will be in the best position to capitalize on the market when that happens. Although there's a low supply of housing into the market because people have been benefiting from the government and central banks' intervention, at some point people will have to put houses into the market in order for them to safeguard the financial stability of their families and themselves. So what should you do at the moment? In my opinion, the best thing to do at the moment is just carry on having a look at the housing market and seeing what's available in your area or the area that you would like to live in. If you're in the right situation where you have enough money that you can actually put towards a house, I think this is a perfect time for you to buy, because more importantly, you're in a position where you can negotiate with the buyers to get a better deal on your house, as well as in a position to benefit from the low interest rates that we have at the moment. If you're not in a position to buy, one thing you can do, which is really nice and simple, is just speak to your current lender and see if you can refinance your mortgage, because saving a few points on the interest rate will save you money in the future, putting you in a much better position for you to get your next property. That's it for today. I hope you guys found this useful. Make sure you subscribe to the channel, click the like button, and I'll see you in the next video.